While the majority of retail traders are fixated on the daily volatility of Bitcoin, a much more significant structural shift is occurring quietly in the derivatives market for Solana. Most market participants are completely ignoring the divergence between price action and the accumulation of spot inventory by high net worth entities. If you are currently holding Solana or considering an allocation to this asset, you are standing on the precipice of a binary volatility event that could wipe out leveraged positions in seconds. The reality is that the market is pricing in a specific regulatory outcome that most people believe is months away. But the order books tell a different story. Over the next 8 minutes, I will provide the on-chain evidence and institutional flow data that suggests a move to $110 is not just an optimistic target, but a mathematical inevitability based on current liquidity constraints. Let us get into the weeds of what is actually happening behind the scenes of the major exchanges. The first thing we need to address is the concept of front-running the news cycle regarding the potential Solana exchange-traded fund. We saw this exact same pattern play out with Bitcoin in late 2023 and again with Ethereum in early 2024. Smart money does not wait for the official press release from the Securities and Exchange Commission to begin building a position. They look for the subtle changes in the language of regulatory filings and the hiring patterns of major asset managers. Right now, the data shows that wallets holding between 10,000 and 100,000 Solana have increased their holdings by 14% over the last 30 days. This is the most aggressive accumulation streak we have seen since the bottom of the bear market cycle. Here is why this matters to your portfolio right now. When you see this level of accumulation occurring while the price remains relatively suppressed, it indicates a deliberate effort to absorb supply without moving the market price upward too quickly. This is a classic institutional accumulation strategy known as an iceberg order, where large buy orders are broken into thousands of smaller trades to hide the true intent of the buyer. The 30-day moving average for exchange outflows has hit a 6-month high, meaning that coins are being bought and immediately removed from trading platforms. This creates a supply shock scenario where the available float of Solana on exchanges is thinning out rapidly. When the supply on exchanges drops to these levels, it takes significantly less capital to push the price higher. This brings us to the critical price target of $110. This number is not pulled out of thin air, but is derived from the volume profile visible range, which shows us exactly where the most trading activity has occurred in the past. The $110 level represents a massive liquidity gap, where there is very little historical resistance. If the price can reclaim the psychological support at the current levels, the path to $110 is essentially a vacuum. In market structure terms, we call this a low-volume node. Price tends to travel very quickly through these low-volume nodes because there are fewer sellers looking to exit their positions at those specific prices. However, the catalyst for this move will almost certainly be tied to the narrative surrounding the spot exchange-traded fund. The market is currently pricing the probability of a Solana exchange-traded fund approval at roughly 20% by the end of the year. This low probability pricing is exactly where the opportunity lies for the contrarian investor. If that probability shifts even marginally to 30 or 40%, the repricing event will be violent and immediate. We must also look at the premiums for the Grayscale Solana Trust as a leading indicator of institutional appetite. In previous cycles, we saw the premium or discount to net asset value on these trust products act as a precursor to spot price movements. Currently, the discount on the trust product is narrowing, which signals that institutional investors are bidding up the only regulated vehicle they currently have access to. This is the same signal that flashed red hot before Bitcoin began its ascent from $25,000 to $70,000. The reality is that Wall Street needs high beta assets to sell to their clients. Bitcoin is the digital gold standard, and Ethereum is the technology layer, but Solana represents the high-throughput casino that retail investors love. Asset managers know this, and they are preparing to package this volatility into an exchange-traded fund product that they can sell to pension funds and family offices. If this data is helping you stay ahead of the crowd and see the market clearly, feel free to join our inner circle by subscribing to the channel for more unadulterated analysis. Now, let us discuss the technical invalidation levels, because a good strategist always protects the downside first. While the target is $110, we must acknowledge the support band that must hold to keep this bullish thesis alive. The structural support currently sits around the 120-week moving average. If we see a weekly candle close below this dynamic support level, the probability of a flush to lower levels increases significantly. However, the on-chain metrics regarding the Solana network activity suggest that the fundamental floor is rising. Daily active addresses on Solana have flipped Ethereum on several occasions over the past quarter. That technician fees remain low, which is keeping user retention high despite the network congestion issues that have plagued the chain in the past. This fundamental growth provides a safety net for price because it means there is genuine demand for the token to pay for gas fees. It is not just speculation, it is utility. When we compare the current market structure of Solana to Ethereum in late 2020, the similarities are striking. Back then, Ethereum was also facing skepticism about its scalability and its ability to attract institutional capital. Yet, once the narrative shifted and the total value locked in decentralized finance applications began to soar, the price followed the fundamental metrics. We are seeing a renaissance in Solana decentralized finance right now. Total value locked is climbing, and stablecoin issuance on the network is reaching new yearly highs. This increase in stablecoin liquidity is often a leading indicator of buying pressure. When investors move stablecoins onto a blockchain, they are usually preparing to deploy that capital into the native asset or the ecosystem tokens. We are seeing hundreds of millions of dollars in stablecoins bridging over to Solana every single week. This is dry powder that is sitting on the sidelines, waiting for a trigger to enter the market. The trigger will likely be a headline regarding the exchange-traded fund filing process. Even a delay that is accompanied by constructive comments from regulators could be enough to ignite this dry powder. You have to understand that the market is currently positioned for bad news. Sentiment is fearful, and funding rates in the derivatives market are neutral to negative. This means that short sellers are paying long traders to keep their bearish positions open. This is the perfect setup for a short squeeze. If the price pushes up by just 5 or 10%, these short sellers will be forced to buy back Solana to cover their losses. This forced buying creates a feedback loop that drives prices even higher, triggering more liquidations at higher levels. Our analysis of the liquidation heat maps suggests that there are billions of dollars in short liquidations sitting just above the current price range, all the way up to that $110 target. The market makers know this liquidity is there, and they have a financial incentive to push price into those zones to fill their order books. This is not a conspiracy. It is simply how market mechanics work. Liquidity attracts price like a magnet. The path of least resistance right now is actually upward, despite what the bearish sentiment on social media might have you believe. Another factor we must consider is the rotation of capital from Bitcoin into high-performance Layer 1 blockchains. Typically, in a crypto market cycle, money flows into Bitcoin first, then Ethereum, and then out the risk curve to assets like Solana. We have already seen Bitcoin make new all-time highs. We have seen Ethereum perform well following its own exchange-traded fund approval. The natural progression of capital flow suggests that Solana is next in line to receive this rotation of liquidity. The risk-to-reward ratio at these levels is heavily skewed in favor of the bulls. If you are entering a position here, your invalidation point is clear, and your upside target is substantial. However, you must be prepared for volatility. The road to $110 will not be a straight line. There will be shakeouts designed to force weak hands to sell their positions before the real move begins. This is why we focus on the weekly and monthly timeframes rather than the hourly charts. The noise on the lower time frames is designed to confuse you. The signal on the higher time frames is telling you that accumulation is taking place. If you are navigating these choppy waters and need a steady hand to help you filter out the noise, hit the like button so this intelligence reaches more sophisticated traders like yourself. Let us look at the potential timeline for this move. Based on the average duration of accumulation phases in previous cycles, we can expect this consolidation to resolve within the next 6 to 8 weeks. This aligns perfectly with the expected timeline for the next round of regulatory comments from the Securities and Exchange Commission. The convergence of technical readiness and fundamental catalysts is what gives us high conviction in this trade setup. It is rare to see on-chain volume, technical support, and a macro narrative all align so perfectly. The only missing piece of the puzzle is the official confirmation. And by the time that arrives, the price will likely be trading well above $110. Investors who wait for certainty are usually the ones who end up providing exit liquidity for the investors who bought based on probability. You must decide which type of market participant you want to be. Do you want to buy when the news is out and the price is high? Or do you want to position yourself when the data is screaming accumulation, but the price is still low? The smart money has already made their decision. They are buying the fear and selling the greed. The playbook for the coming weeks is simple, but requires discipline. If you are looking to build a position, dollar cost averaging into these dips is the most prudent strategy. Do not try to catch the exact bottom because you will likely miss it. Focus on building your average entry price within this accumulation zone. Once the price breaks out and reclaims the key resistance levels, you can look to compound your position. The target of $110 should be viewed as a first take-profit zone, not the final destination. If the exchange-traded fund narrative gains real momentum, the price discovery phase could take Solana significantly higher. But for now, keep your eyes on the data and ignore the emotional swings of the crowd. The institutional flows are the only truth in this market. Everything else is just noise. As always, please remember that I am a strategist sharing market intelligence, not a financial advisor. All financial markets carry risk, and you should perform your own due diligence before making any investment decisions. The data indicates the move is coming, so make sure you are prepared.